on what drove today's trading. Let's go straight to our street fighters for the rest of the market roundup. Larry Shover is in Chicago, here with us in New York. John Manley of Wells Fargo Advantage Funds. He's the chief equity strategist there. And of course, our closer, Barry Knapp, is still with us from Barclays. John Manley, you heard the folks talking about U.S. growth concerns. We've also got geopolitical concerns front and center right now, with the North Korean news agency saying that North Korea has formally informed the White House and Pentagon that diversified nuclear strike means have been ratified. More noise from North Korea on this sort of tit for tat, but investors are focused on it.
Well, it's not good for multiples, obviously. I mean, I think there are these concerns out there, and international concerns can always flare up, and I don't want to make light of them. On the other hand, North Korea has been making noise since I was born a long, long time ago. So I think you have to put some of this in perspective, and you can't really jump around with it. I think the market is up an awful lot. I don't think it's particularly expensive. I think, though, news like that after a market rise can rattle things a little bit.
Larry Shover, markets ticked down when that headline crossed. The S&P dropped about 4 points and then recovered very quickly. What's your take?
My take is traders don't know what to do. I mean, right now, it's as if the market was down a lot more than it was. People are saying, why wasn't the market down more than it was? People just do not know what to do. It's like half holiday mode and half vacation mode. Nobody knows exactly what to do right now. People do realize that this situation is inherently unstable, and it has been for a very long time. But when's the next shoe to drop? When's that going to happen? And that's the big question right now.
Well, Barry Knapp, when's the next shoe to drop?
Well, I think that if I step back from this and say, you had this earlier segment about all the central bank policy. I think there's been this over-reliance on what central banks can actually do for real economic growth. They can mitigate the risk of deflation, they can create inflation, but creating real growth is problematic. So, for example, we've been recommending stocks with high dividend yields all year. They're in the sweet spot of Fed policy. It's worked great. At the end of the quarter, those stocks absolutely just went parabolic. So
why? Because you had to show your investors that you were long all the winners in the quarter-end report, so it's a game?
There's some of that. There's also a bit of a feeding frenzy going on in things like high-yield deals. And so Fed policy has pushed things to a point where there's this over-reliance, and we're up to some extent, not on core fundamentals. We're about to hit earnings season, so that would be my next shoe to drop, which is, are the fundamentals actually strong enough to justify the performance that we've had in the first quarter? I would argue not really.
Well, let's also not forget, John Manley, that we've seen cash moving into the markets. We've seen the retail investor back, and perhaps to Barry's point, they're putting their money in high yield. They're not getting that kind of return in bonds, and they're also going into defensives, which is interesting.
4 years of moving out, 4 months of moving back in. I can't say that it's over, but these things pause. I mean, I'm not so sure the Fed is a terrible reason to buy the stock market. You're sort of getting forced into it. Individuals have been getting by with zero return, essentially, in risk-free investments. The Fed's been pushing you in that direction. I think there's a little bit of caving in. I think there's a little bit of market exhilaration. But the things that drive the market forward, the earnings are still okay. I think Barry's right. I think we may have a few missteps because the dollar's up in the short term. But earnings are still, on balance, rising when they really weren't supposed to.
John, define okay. Is okay 3 to 4% earnings growth? Is it the flat growth we saw in the fourth quarter of last year? What's okay?
I think earning okay is actually not so much a percentage point as, let's say, 65 or 70% upward revisions as we go into the quarter. If we start to see more signs of people actually coming in above the number,
in other words, the analysts are too low, so they start revising their numbers up.
Companies move the analysts a little bit lower as you get close to the quarter, and they have a tendency to sort of fill it back up as you actually announce it. We may catch more of the downside.
In other words, Mom, Dad, I'm going to get a C, and you show up with a B, and it's not so bad.
That worked. Right.
Well, Larry Shover, we've got geopolitical concerns with North Korea. We've got earnings season upon us, and we've got 2 major central banks in the next 24 hours. What are you focused on most?
I'm still focused on being in a step-aside mode. I mean, I think our situation is inherently unstable. Now, to be honest with all the Bloomberg viewers, I said that on February 22nd, and I still believe that. I don't think coast is clear investing ever makes sense. Preparing for Armageddon ever makes sense. However, I would pare down and wait. I just think we're in an unstable area with Europe, with our earnings season. They've ramped up earnings from $107 per share at the end of 2012 to about $112 per share right now. I think it's unstable. I would step aside and just wait. There's nothing wrong with being in cash and wait for negative investing and just start investing when we correct, which I think will happen sooner than later.
Barry, you're the head of portfolio strategy at Barclays. A lot of people come to you and say, what should I do? So what are you telling them?
Well, as I said, we've been suggesting you can hide out in these dividend names for some time, but they've had a huge move. What ideally would happen for us is we would get a pullback here, and what we would look to do out of that pullback, the weakest part of the economy last year was capital spending and capital spending related. So things like enterprise tech, machinery names, even chemicals, which people got overly
purchase items that businesses need to run their businesses. They held back because there were so many tax
capital spending was weak because of public policy uncertainty.
Right.
We've had wave after wave of that. We don't think that that's going to occur this year. So at the right price, after a pullback, buying into the industrial sector, for example, to us, would make a lot of sense. But at this level, having had a 10% first quarter return, I'm not particularly comfortable with that trade. So I would like, others probably would as well, but like to get a pullback to be sure.
Sure. A pullback of 3 to 5%.
More like
John Manley,
5 to 8.
Pullback?
I'd say I take the 3 to 5.
We've got two kind of bearish forecasters
That's not
here.
that bearish.
No, not really.
Well, it goes against the grain a bit. Barry, I know you're going to stay with us, and we want to thank Larry Shover out in Chicago, and of course John Manley from Wells Fargo Advantage Funds. And that was a nice little roundup of all the trading themes.
That was our roundup, but I tell you what, we have your first trade for tomorrow. Here's a look at what's coming up on Street Smart.